Well, you're absolutely right that the economy needed more help. After the intensification of the financial crisis in September 2008, the US economy contracted at about a 9% annual rate in the fourth quarter, another 5% in the first quarter of 2009. Something like 5 million jobs were lost over that period. And so clearly a lot more help was needed. But as you mentioned, the Fed's standard interest rate, the federal funds rate, had been brought down to zero by November, December of 2008. So we needed additional tools to stimulate the economy. Now, this is called in economics lingo the zero lower bound problem, the problem that under normal conditions you can't take the short rate below zero. Of course, there are some negative rates, but not very far negative. So that issue actually had been studied for many years at the Fed and elsewhere. I remember in 1999 attending as a professor a conference sponsored by the Fed on ZLB, zero lower bound monetary policy, and buying assets was one of the things that got talked about. So it was not a totally new idea. The Japanese were doing something like that in the early 2000s. I would argue that was not exactly the same kind of approach, but nevertheless, they were buying some kinds of assets. In 2003, when the federal funds rate got down to 1%, Alan Greenspan, chair at the time, told the staff to look at this issue again, and they did. So I did not invent LSAPs by any means. I did contribute to their development. In 2002, when I became a governor, I gave a speech about tools that could be used in the event of deflation, and I talked about asset purchases as one possibility. I then wrote a series of papers with board staff, including Vincent Reithart and Brian Sack, where we looked at asset purchases and other tools and tried to evaluate the impact that they would have and so on. Vincent and I wrote a short paper which argued that they were basically, the basic strategy would have to be, if short rates were at zero, get longer rates down if they were still positive. And in 2008, the long-term interest rate was still 3%. And we argued in our short paper that there were two ways to do that. One way was what's called forward guidance, basically telling the markets that we're going to keep rates low for a long time, and that should bring long rates down as well. But the other thing we suggested was buying long-term securities. If you buy long-term securities, you drive up their price, you drive down their yield, and that should help stimulate the economy by lowering mortgage rates, by lowering the cost of capital for firms and the like. So that was our strategy. We actually used it in the fall of 2008 when we bought mortgage-backed securities to try to make that market work a little better. But our first big LSAP program was in March of 2009. The Bank of England did a similar program just a few days before the Fed, but the Bank of England and the Fed were basically the two pioneers in terms of using this strategy to try and provide extra stimulus for the economy. Well, there was no perfect precedent, so we didn't have a great historical example to look at. Christy Romer once argued that asset purchases during the Great Depression were helpful. We didn't pay much attention to that period. We looked more at the World War II period. Between 1942 and 1951, the Federal Reserve put a cap on long-term interest rates, not for macroeconomic purposes, but in order to help the government finance the costs of World War II. And so that was interesting that the Fed could keep a cap, on long-term rates that long, and we studied that in some detail, and ultimately concluded that markets had changed and grown and become so much more sophisticated than they were in 1942 that the lessons were somewhat limited for us. Then, of course, we did look at the Japanese case, but that, even though it was called quantitative easing, which is the term that was applied to our asset purchases, it was a different type of approach. Their goal was to increase the money supply by adding to bank reserves. It was a different strategy. They mostly bought shorter-term securities, not long-term securities, as the Fed would ultimately do. Then finally, in some of the research, like the work I did with Reinhardt and Sack, we tried to look at not previous policy episodes, but other kinds of information that might be useful. For example, I think it was 2001, the US government stopped issuing a 30-year treasury bond. And so there was suddenly a reduction in supply of that type of security. And according to the LSAP theory, that ought to lower the yield on 30-year, raise the price and lower the yield on 30-year bonds. And that's what we found. And we used that as trying to estimate the effects of the asset purchases. So there was no perfect historical precedent. And indeed, we went into this with a lot of uncertainty about exactly how big the program should be. But of course, we knew that if it wasn't big enough, we could always do more. But there was a lot of uncertainty about what the effect would be. The strength of LSAPs, or QE as is more popularly known, is that it gives the central bank the ability to provide more stimulus when the economy needs it, and short-term interest rates are already at their zero lower bound, or perhaps a little bit negative if the central bank is willing to try that strategy. So that's an important benefit, that you can reduce unemployment, get inflation up to target, even if the short-term interest rate cannot be cut any further. And as you say, I did calculate that QE plus forward guidance, those two things together, added about 3 percentage points worth of policy space for the Fed. Now, it could be less, it could be more. There's a lot of uncertainty, but certainly it's a meaningful increase in what the central bank can do, and that's the main strength. I think there's some weaknesses. Perhaps the most important in terms of practice is that we don't know with great precision exactly how big the effects are of asset purchases and what they depend on. There's a debate about whether, for example, QE works more effectively when markets are in a distressed situation, or whether they work about the same, whatever the condition of the markets. So there's a lot of uncertainty about exactly how big the effects are, how long they last. And as a result, the Fed, whenever it can, uses the federal funds rate, the short-term interest rate, as its main policy tool, because with many, many years of experience, the Fed has just much better sense of exactly how much effect a given increase or decrease in the federal funds rate will have. So that's an issue. Related to that is that QE it has information content. When the central bank announces a QE program, that says something about their overall strategy and how long they expect, for example, to keep short-term interest rates low. So we saw in a negative event, in the 2013, when we tried to slow the pace of our asset purchases, the markets interpreted that as saying that we were also going to be raising short-term interest rates very soon. And the result of that was what was called the Taper Tantrum. So that signaling aspect is why the Fed tries to separate rate policy from LSAP policy. And again, another reason why it can be difficult to assess the impact of a QE program. We also have to think about the reverse, with a period like now when the Fed is reducing its balance sheet, are the effects symmetrical? Are they somewhat less? That's, again, a question that I think requires more attention. In terms of the costs, I think many of the costs that were attributed to LSAPs have not proved to be really very serious, as I discuss in my book. I think the one area where we're still quite uncertain has to do with the financial stability issue. Do protracted periods of easy money make financial vulnerabilities greater? Do they add to the risks that there might be some kind of crisis? I think we know very little about this, frankly, and we need to learn a lot more. My sense is that QE is not special in that regard, that easy monetary policy sustained over a long time could have the effect of making financial stability more of a problem. I don't think that QE is particularly vulnerable to that critique, in particular because asset purchases usually only take place in deep recessions when risk taking is already too low, not too high. So that's not what I think of as the main issue, but it's certainly something that we should look at more in the future. I think that our experience and the international experience suggests that LSAPs or QE and forward guidance are the two mainstays, the two most powerful and reliable tools that we have beyond rate cuts. And I would add, as I said, that we were two pioneers in 2009, the Fed and the Bank of England. In the COVID pandemic, something like more than 20 countries used asset purchases as a tool. So those are the two most important tools. And I think as long as the neutral rate of interest doesn't get too low, that they could be adequate for at least a moderate recessions. But in a more severe recession, we might want to look at other tools. In my book, I don't make strong recommendations. I look at some possibilities that have been used in other central banks and sort of look at pros and cons. I think some that at least deserve attention are negative interest rates. Modestly negative rates in Europe have eased financial conditions. And although there have been concerns about the effects of negative rates, say on bank profits, there's not much evidence so far that banks have been damaged by negative rates. Something the Fed looked at, I think, in their review was medium-term yield curve control. That is setting interest rates at a target at, say, the 2 or 3 year horizon and using purchases of securities to enforce that target. That's not the same as Japan, which targets the 10-year yield, but I think a shorter duration might be feasible for the Fed. And I think they did look at it, but decided not to adopt it. One other possibility I'll mention is what's called funding for lending, which has been used pretty successfully by the Bank of England and the European Central Bank, and to some extent by the Bank of Japan as well. The idea is that the central bank tells the banks that if they increase their lending to the private sector, maybe to certain classes of loans, that the central bank will help finance those loans with cheap money, low interest rate loans for an extended period. And in Europe, large amounts of this money has gone out and has helped provide credit for firms, including small and medium enterprises, for mortgages, et cetera. We here in the United States, we use something called the Main Street Lending Facility, which was much more complicated. The advantage of a funding for lending program is that it's inherently a simpler approach. And maybe next time we have a recession accompanied by credit market strains or banking strains, that might be an approach that the Fed might look at. So those are some possibilities that could be looked at. But again, I think LSAPs, quantitative easing, and forward guidance are probably the two most powerful tools we have, other than short-term interest rates. Well, fiscal policy has played a big role in the last two recessions, both of which were very big ones, the pandemic recession and the Great Recession following the global financial crisis. Given that the Fed's policy space, the room it has to cut rates, and even with the use of non-standard tools like LSAPs, that's limited, there are going to be circumstances where fiscal policy will be a useful and perhaps essential addition to getting the economy back on track. And I don't think it has anything to do with necessarily with Fed independence. The Fed will handle monetary policy, Congress will handle fiscal policy. There'll be loose coordination in the sense that at least Congress will listen to what the Fed chair has to say, but decisions will be made independently. I think fiscal policy is very powerful and doesn't have to be concerned with the zero lower bound on interest rates. It does have a drawback, which is that because it has to go through a complex political process, it's not a very nimble tool. It's not one that can respond, within a short period at a perfectly measured way. to a given set of issues. So I think it would be good if, for example, Congress would consider putting some more automatic stabilizers into the system. That is, programs like unemployment insurance program that kicks in automatically when the unemployment rate exceeds a certain level, or there are other mechanisms like that where the law is in place before the recession that allows for tax cuts or spending increases to automatically occur when economic conditions weaken. That makes things much more rapid and avoids some of the complexities and delays in the political process. So that's, I think, something that Congress ought to consider, although they've not shown to this point a great deal of interest in that approach. I think that's very unlikely to be a good approach. The Federal Reserve is obviously full of experts who have spent their lives working on monetary policy, that just knows a lot more about how to run monetary policy than the fiscal authorities. And importantly, it's I think the ability to run policy in a nonpartisan way, so that it's not reacting to the latest news cycle, but it's actually planning over long periods of time, the framework, the approach, the forward guidance, I think is very important. And the MMT approach that you described, if the Fed is no longer independent, then it falls on the fiscal authorities to control inflation. And again, with the best will in the world, I'm not sure that the fiscal authorities have either the knowledge or the ability to move in a quick and sensitive manner in order to control inflation. So I think if we want to keep inflation low in the long term, and of course the Fed is right now fighting an increase in inflation, that Fed independence is an important component of that. It's a hard problem because there are a lot more questions than there are data points. And so it takes a lot of ingenuity to figure out, how to get a good assessment of the effects of LSAPs. But I think there are some very important questions, and if people can address them, they would be great. The first, as I alluded to earlier, is that we don't know very precisely how powerful QE is and under what circumstances it's more powerful or less powerful. So anything that could be done, maybe now looking at the range of countries that have tried QE, would be useful in trying to figure out, again, how powerful QE is and what that power depends on. Does it depend on the state of markets? Does it depend on the size of the fiscal deficit? Does it depend on the level of risk-taking in markets? I mean, there's a variety of things that could affect how QE affects the economy, and through what channels it affects the economy. Does it work through banks? Does it work through mortgages, capital investments? Though that's, I think, a big issue that a lot of work's been done on, but we still don't know the answers. A second thing is what economists call the reaction function. How should we respond? Should we tell the public, here are the circumstances in which we will use LSAPs, and here's how much we'll do? If we could do that, that would reduce uncertainty and would allow people to markets to understand better how the Fed will respond to certain circumstances. I don't think we know enough to put out, a formal reaction function. It's striking that LSAPs don't play a big role in some of the Fed's formal guidance. For example, the so-called dot plot looks only at rate increases and not at balance sheet variables. So communication and reaction functions, how do you use it and how do you communicate that to people, I think is very important. A third issue that we hear a lot about when I was chair and we introduced new QE programs, we got a lot of complaining, not just from some people in Congress, for example, but also from foreign leaders who complained that there were spillover effects that were disruptive to their economies in one way or another. And I think that's a question that maybe has been under-researched. To what extent, when a big central bank like the Fed or the ECB undertakes asset purchases, to what extent does that affect global financial markets and global economies? And there's a lot of interesting ideas there, but I think more work would be useful. And then finally, I think we just know way too little about this issue of financial stability. My own preference, let me just say, is I think financial stability risks are best handled by strong regulations, supervisions, and macroprudential policies. I think we've done a lot. Dodd-Frank was a good step in the right direction, the law in 2010, the reforms, but I think there's a lot more that could be done, particularly in the shadow banking system, to make our system stronger and more resilient. So that if we could do that, that would take the pressure off monetary policy. But given that we haven't done that, we do have to worry about the effects of different kinds of monetary policy on financial vulnerabilities in the economy. And one of my concerns about doing that is that we just know so little about those linkages, at least in a quantitative sense, that it's hard for us to judge exactly, even if we're in all the goodwill in the world, want to take that into account, we just don't have the information we need to figure out, quantitatively, how much does that mean about, what does that say about interest rates? What does it say, how should we modify our regular policies to take that issue into account? And so I think, again, a lot of scope for work on that very important issue. I think that's the main direction in terms of the costs of LSAPs that scholars could provide help to policymakers on.